Yeah, those markets are reacting to the latest U.S. jobs data, which showed an uptick in jobs for the month. But there are some other parts to it as well. Let's get more from Steve Rowles, Senior Portfolio Manager at TriVest Wealth Counsel at Wellington-Altus Private Counsel. And Steve, thanks very much for joining us.
Roger, great to be here.
Your thoughts on the initial numbers. What do you see that's good? What do you see that's a little more concerning?
Yeah, interesting day. My 25-plus career, I don't think I've ever seen a day when we've had so much data and important data. But looking at it collectively, it's somewhat of a no news day, and we're more focused on the employment numbers coming in January. It sort of saw two sides of the tail there. That in October they were down 64,000 and up in November, and so the market's just really looking at, okay, how does that apply to justification for the recent Fed cuts, and looking ahead at projections and the futures for Fed cuts for January, March, and April. No changes day over day, so it's really not a big change. And the market's down, over half a percent on the stock market, and yields are down a few basis points as well. So let's primarily focus on January non-farm payroll.
Is that what everybody's waiting for? What about some of the other numbers that have come out?
Yeah, some of the other numbers that's important. We saw the retail sales, which came in a little bit under expectations. We're expecting 0.1, came in at 0. So it's that argument that the consumer is not as strong as some thought, and mixed with the employment means that, well, perhaps there's a 25% chance of a rate cut in January. But let's get more information. We'll get more information later this week with CPI data, and continuing story will develop with the Fed. What are they going to cut more or not? But primarily what I'm looking at the Fed is, what is their quantitative easing program going to be? I think that's more important than the actual cutting of rates at this time.
And what would you like to see with that?
What I would like to see, or what I think I'm going to see, it's a different thing.
Two different things.
We've had I call it artificial capitalism in the U.S. with these quantitative easing programs since 2008, which was a one-time emergency measure brought on by Ben Bernanke, who was an expert on 1929 crash, and with the Depression, and what would have stopped that was effectively what happened in 2008. Fed did a great job. But we've continued that philosophy for many, many years now. Now we're coming up to our second decade of it. And when the Treasury is issuing $1.9 trillion of treasuries, who's going to buy it? And when you look at the Federal Reserve balance sheet, they're the ones who are buying most of the treasuries. They've just announced they're going to buy another $45 billion a month. So, if they hold over $5 trillion of treasuries and China holds about $800 billion, well, talk about the independence of the Fed. They really are the ones who are helping out the Treasury the most with funding the U.S. economy right now.
Okay, I want to get on to a couple of other subjects right now. One of the key earnings out today was Lennar, 46% slip in profit in the third quarter.
Yeah, that was the last quarter, and so they report later, and I'm a little bit concerned about Lennar. It's the housing market altogether. We saw it last week with Toll Brothers. Housing is not strong in the U.S., and compressions are starting to compress a little bit, and the actual valuations are quite high too. But it's really the excess demand or excess supplies and little demand, and so that without a strong housing market, I'm concerned about the U.S. market altogether. And now they can take rates down again, but it's not like Canada and the U.S., because in Canada, you get a 5-year mortgage and lower rates help trigger some stimulation in the housing market. But in the U.S., you get a 30-year mortgage and they're not portable. So you're not going to be selling your home. So if you got a mortgage 5 years ago for just over 1% or 1 to 2%, why are you going to sell your house, move across the street, and get a new mortgage? 30-year rates about 6.3. So that's sort of the main issue that the U.S. is dealing with right now, is that the housing market is tied to the mortgage market. And I don't see that changing unless there's some drastic fiscal policy changes, which have been talked about, but nothing really proposed that would unlock the value for housing.
And what kind of an impact, excuse me, what kind of an impact does that have elsewhere then?
It has an impact because of, in Canada, we're so focused on the mortgage market that the Bank of Canada has really been lowering rates to help that. In the U.S., it really hasn't made a big difference. And we're seeing the U.S. has lowered rates dramatically over the past year and a half here, but the U.S. 10-year is still at 4.15. And so it's not having that big of an impact. So I think that really the market is going to be more focused, not so much on the Federal Reserve cutting rates. It's going to be more focused on the bond market and what the bond traders are going to be doing with bonds. So I think we're in for an interesting year.
Okay, I want to get, we're almost out of time, but I want to get into the three stock picture. You're looking at Verizon first off.
Yeah, Verizon is a big telecom. Everybody knows about it. It's got about a third market share, but it's got a really nice dividend of about 6.8%. And as you can see by the chart, it has come down a little, but I'm quite optimistic on it because they have a brand new CEO who is a real turnaround expert. He came from PayPal, where he generated 3 times revenue during his tenure there. Previously, he was at Virgin as well, and actually started his career at AT&T. So he knows the business, and he's really focused on cost cutting. He's already announced some layoffs and cost cutting efficiencies, but more importantly, he's really focused on the customer service, so a cultural change there. So I think when you look at a company like Verizon, yes, it hasn't done that well, but it's really, when you add in a 7% dividend, I think in this type of market with geopolitical issues and whatnot, I think it's a great total return stock. So it's not just about the price appreciation. Let's get that dividend as well.
Okay, Steve, sorry, we got to wrap it up there. We're tight for time, but the other two you'd like to tell us from BAE, but we'll have to wrap it up there. Thank you, as always, for joining us.
Appreciate it. Thanks for your time.
Cheers. Steve Rowles is Senior Portfolio Manager at TriVest Wealth Counsel with Wellington-Altus Private Counsel.